Good morning, everyone, and welcome to today's training event. We are a little bit early. This is great. For those of you that dialed in a little early, that's awesome. You're going to have an opportunity to go ahead and get some very useful handouts that if you look in your go-to webinar control panel, there's a tab there that says handouts. Those are all downloadable. So while we're waiting, we're going to start promptly at 10 o'clock, which is about 4 minutes. Go ahead and start downloading those handouts. Don't worry about knowing what they are right now. We'll explain them at the end of the training, but they're very useful. They're going to be certainly something you'll take quite a liking to, certainly after the call, if you get a better understanding of how to use these products and incorporate them into your business plan. So we're going to start, like I said, in roughly about 3 minutes. So please go ahead and start downloading those handouts. And if you have any questions, you'll also see that in the control panel, there's a question tab. You can type questions all throughout the webinar that we'll get to at the very end. And we won't read your name out, so please don't feel like any question is a dumb question. And quite honestly, some of the best learning nuggets come from the questions that you guys do ask. So sit tight for just about another 2-3 minutes. Grab those handouts. Ask questions now or any comments that you have, and Mark from Issue Insurance or myself, Keith with OneAmerica, will be beginning very shortly. Thanks for joining early. Your host, Mark George from Issue Insurance, is going to kick us off this morning.
Good morning. Can you hear me?
Loud and clear, Mark.
This is Mark George with Issue, and first I want to say thank you for your business and for attending our first in a 4-part series of webinars on the OneAmerica suite of asset-based long-term care solutions. And when I'm done presenting today, and the host is Keith Birkin from OneAmerica. And before I turn it over to Keith, let me quickly set the table. And I want you to ask yourself, do your clients need your help? I mentioned that there's a 4-part series. You'll be receiving invitations to 3 additional webinars. The next one I'm really excited about because it'll go into case studies and help you in your practice. So I want you to continue to ask yourself, do your clients need your help? And 10,000 Americans are reaching age 65 every day, and 1 out of every 7 people 65 and above will need LTC for more than 5 years. And the average cost of a 5-year stay 30 years from now will be just under $2 million. Do you think your clients can afford that risk to their portfolio? Do your clients need your help? So there's been a lot of events in the news, and I want to kind of bring you up to speed this year what I've seen. It may have started with the January 17th Wall Street Journal article reporting on policy owner concerns about steep rate increases, long-term care policy owner concerns. And the article, although it wasn't entirely accurate, because it didn't explain that when a carrier has a price increase or a rate increase, that they're, in almost every case, they're offered a reduced paid up non-forfeiture option, whether required by the contingent non-forfeiture guidelines or not. And then they also didn't mention that carriers, long-term care carriers, are paying about $10 billion in claims per year. So there are policyholders clearly benefiting from traditional long-term care. But I ask you, with what's in the news, do your clients need your help? And for some reason, there we go. Barron's had an article, and in a lot of cases, I think they just pile on. Forbes, Think Advisors, General Electric, GE, Genworth, 1 out of 4 long-term care policies on the planet are Genworth, and they are saying that they're reserve gap may be $300 billion. So I'm asking you, as your clients read this news, do they need your help? Recently, with the new budget passed by the Trump administration, there's been a cut to Medicare spending. So I think there's going to be fewer choices for government paid help in the future. So I ask you, do your clients need your help? So I've talked to a lot of advisors who they have clients who are reading the news and they're froze, and the advisors look the other way because they don't want to risk the business they have with the clients by promoting long-term care. But that is a big mistake. It's a huge opportunity for you because clients are thirsty for solutions. So today, we're all familiar with traditional long-term care, but today Keith's going to tell you about a linked benefit solution that's been available for a long time. It's very popular, and I think you're going to agree with me that it meets a lot of clients' needs better than traditional long-term care. That doesn't mean traditional long-term care is dead, but in a lot of cases, clients with assets would be better served with a linked benefit product. Okay, Keith.
Awesome. Thank you, Mark. And you can hear me loud and clear as well, right?
Yes.
As well, so you can see my screen?
Yes.
Okay, fantastic. And Mark, thank you. And actually, I'm going to piggyback a little bit on what Mark was talking about and the need, how expensive this is. But really importantly, what I think you're going to gain from what I'll talk about as well before I go into our financial solutions is how to start the conversation with your clients. And quite honestly, what it is that is provocative, creating the need, establishing how important it is to have a plan in place. And this is done by asking two simple questions. I'll tell you, I've been in the industry going on 18 years. An agent for 2 or 3, and then wholesaling for the last 15, 16, and all I do is focus on training advisors, agents of all walks of life, DI, health, annuity, life sales, financial advisors, what have you. And our training comes from very broad depth on and from what definitively is working and getting people to budge. I know one of the biggest issues is you show illustrations, the clients kind of know they need this, but how are we turning illustrations into applications? And I'm going to show you how we do that. And yeah, as Mark said, I'm going to show you some very unique financial solutions to solve for the problem that you have. Unless you've seen our products, I can guarantee you have not seen anything like this. What I'm talking about are things like unlimited or lifetime benefits with guaranteed premiums that can never increase, the ability to fund this any way your clients like. Annual pay, 10 pay, 20 pay, single pay, qualified money, non-qualified money, annuities that will mitigate all the taxation that are associated with their existing annuities. One single premium covering 2 lives. I mean, it's got all the bells and whistles and all the unique niches that make this so stand out. But before I get into the product, which you're going to love seeing, I want to go into a little bit of a deeper dive, spend 10 minutes on what Mark talked about. And why? Because you can share the most incredible financial solution that fits your client's financial need perfectly. But if they don't believe they're going to need this and understand how important it is to plan for this, I'm going to tell you right now, you're not going to go anywhere. So just a little bit of a deeper dive into how expensive this really is. Right now, this is based on a 2014 cost of care survey that published by Genworth in April 2015. Average cost for 1 year private room in a nursing home is over $87,000. Now let's just take a very modest inflation increase of 3.5% a year, which by the way has now exceeded education. The cost of long-term care insurance and its inflation index has now exceeded education. Let's just assume 3.5% inflation. In 10 years, it's going to cost over or almost $125,000. In 20 years, 1 year of care is going to be almost $175,000. Very expensive. And this is going to speak to people that are thinking, you know what, I can self-insure, but we'll go into that in just a moment. But honestly, I want to pause for a second because this really isn't telling the whole story. This is just illustrating an inflation increase of 3.5%. But there's 4 things that are going to happen in the next 10 years that are going to dramatically increase the cost of long-term care. And the first is the baby boomers, the second largest segment of our population. Nearly 80 million people are going to be hitting their 80s in the next 10 years. The first wave of baby boomers started hitting 70 2 years ago. 10,000 people a day turn age 70, which presents a fantastic opportunity for this industry, but it also puts an enormous burden on supply and demand. Because as it stands right now, there's already a huge dissonance between supply and demand. When you have the second largest segment of our population hitting their 80s in the next 10 years, you're going to see that ratio get even more distorted, further driving up the cost of care. And then we have medical technology. I mean, this is a good thing because things that were killing us 30 years ago are now chronic conditions. So we're living much longer than we used to. We're not dying straight out. Things like high blood pressure, high cholesterol, diabetes, a variety of cardiovascular disorders were death sentences 30 years ago. They're not today. We're living well into our 80s and 90s, dramatically increasing the chances we'll need care. And then we have family dynamics. Most of you, I think, know that nursing home was always really the only option for many years, and you now know that home care is usually the first place people will start out, and almost 75% of all care will take place at home. But I'll bet what you don't know, and even more importantly, what your clients don't know, 70% of all home care is provided by family members. And by the way, these very cool financial solutions that I'm about to show you that will access your clients' qualified money and erase taxation on their annuities and just make great use of their sideline money, that's all really great stuff, and it's exciting to present, but it's not the reason why people are buying it. People are buying LTC protection, whatever form it is, to protect their family. It's the number one reason people buy a policy, regardless of the chassis of the policy. They want to protect their family. This is what's selling this. But this dynamic is changing as well, because you have mom and dad retiring in warmer climates like South Florida, Arizona, California. The kids are staying put, and they're not able to provide the family care they used to, which is actually good. It takes the burden off the family, but then, of course, puts it on their own financial portfolio. And then Mark kind of touched on this, the government. I don't know if you're aware, but 42% of all long-term care is paid for by the government. And that's great, and that's there for people who are indigent or impoverished themselves. They start paying out of pocket, and they go as long as they can. But what I can absolutely, positively promise you, the trend is not going to last. The entitlement programs are simply going bust at both the state level, and federal funding is getting slashed towards the entitlement program because they're unsubstantiated. And whether it's this administration, the next one, or the following one, I can absolutely guarantee you Medicaid and Medicare is not going to cannot continue to keep paying for LTC costs at the clip it's going right now. So there's a problem. It's all going to be more expensive. And by the way, this $125,000, $175,000, that's just for 1 year. Average length of care for a man is almost 2.2 years. You're talking $384,000 nearly 20 years down the road. For a female, it's just shy of 4 years. You're looking at almost $645,000 20 years down the road. Now, for people who are self-insuring or thinking that way, it's getting a little more hairy. But let's talk about the real number, which is 8 to 20 years. People will live 8 to 20 years from the beginning onset of Alzheimer's. And that's just with one of them on claim. You're looking at an average possible claim or LTC expense paid out of almost $1.4 million. You know what I call that? I call that the Titanic. Your clients that are sitting on $1.2 million, $1.4 million, they're in their 60s, mid to late 60s, early 70s, retiring, feeling like they're absolutely untouchable. They're the Titanic, right? When the Titanic was built, it was the strongest, biggest, most unsinkable ship ever built for its time, and it sunk in 45 minutes. You're sitting on a portfolio of $1.4 million. You're feeling pretty unsinkable. One of you, as a spouse, gets Alzheimer's. Your portfolio is going to sink, maybe not as fast as the Titanic, but it will sink even though you felt untouchable. The biggest issue we have is the occurrence or the frequency. There's about a 70% chance you're going to need long-term care. So, when you're in a room, look around. 7 out of every 10 of you are going to need long-term care in some capacity once you're over the age of 65. The question is how much, how long? And the big problem is people don't think it's going to happen to them. Everyone thinks they're in the 30%. And you look around a nursing home, every one of them thought they'd be in the 30%. And that's the issue. And this is what we're dealing with. And this is all good stuff. These statistics are great. These percentages are great. But you know what? It's not what sells this. This is for you guys to understand. Just because the traditional LTC industry has shrunk, the problem hasn't shrunk. It's gotten worse, actually. And it's only going to get worse. It's just your options have changed. So what I want to show you now is how you talk about this and how you present this to your clients. And this is the difference maker. And it's done as simply by asking two questions. The first being, look, Mr. and Mrs. Jones, you may never need care, but God forbid if you did, have you considered how it's going to impact your family? I didn't ask about insurance. I'm not talking about their money or their portfolio or anything like that. I'm saying if this happens, have you considered how it's going to impact your spouse, your children? The very people who you always swore that you would protect are the people that you're impacting by not taking the necessary protection. Your children who have jobs and their own children and homework and soccer practice completely uproot their lives when a care issue happens with their parents. And the idea is we want to do the right thing and protect yourself and protect your family. That's who this impacts most. And then the second question is, look, if you needed care, how are you going to pay for it? Have you considered that? And are you aware that the only thing that pays for this is your own income and your own assets, which you've aptly allocated for retirement and maybe hopefully some legacy planning. And you might want to explain to them, because most people or some people think Medicare is a solution. We obviously know it's not, and their Medigap coverage offers zero response for LTC expenses as well. And this is where you make that very simple, very easy transition into using the linked benefit, the asset-based approach, into protecting their entire portfolio. Because what you'll do is you'll look at their portfolio now, and what you're going to find is most people will generally have some lazy money that they're not using for income. It's money that's earmarked for some kind of disaster, some kind of scenario where it's their emergency money. And what you're going to do, this is the beautiful thing about linked benefits, is you're really just going to re-intention that money, repurpose it. They're really never buying anything, because they're just shifting that money that's in their portfolio now from their left pocket to their right pocket. They're keeping it in their portfolio because they always, for the most part, with all of our linked benefit products I'll speak to, they maintain control of that asset because it's almost always liquid, almost entirely 100%, depending upon the product you go with. So they'll shift that money. They'll get a cash value and a death benefit out of it, and a long-term care balance, of course, as well. And with us, and you won't see this anywhere else in the country, is a lifetime benefit of long-term care they can never outlive. What I really call this, it's insurance for people that don't want to buy insurance. It's really just a better way to self-insure. But what you're doing is you're using a small portion of their portfolio, keeping it liquid to protect the entire portfolio. And that's what we're going to talk about. And there's fantastic solutions here. So we're going to talk about our product suite and go over these financial solutions with you, give you a really good understanding of how they work. So please don't hang up. Yes, I do have 9 products, but let's deduce for a second. I'm not going to show you 9 products. Don't worry about it. First of all, we're not going to talk about legacy care or immediate care. So now we're down to 7. Then we have our asset care. There's 4 products there. Those are whole life linked to long-term care. And we have the annuity care products. There's 3 there. So let's make it even more simple. The asset care, it's really just one product. It's funded 4 different ways. Where's your money? How do you want to fund it? So it's really not 4 products. It all works exactly, pretty much the same way. The way you fund it is what makes it different. And we're even going to file it that way within the next 18 months. And the annuity care, there's 3 different products, but again, they all work pretty similarly. As a matter of fact, after I show you just one of them, you're going to really understand in base concept and design, they all work exactly the same way in concept. But what I really want you to get from today is don't concern yourself with remembering how the products work. after today's call. You're going to be with us for 4 trainings, and I can almost 100% guarantee you, after I show you what you see today, you're going to want to see the other trainings because they pile onto this, and you're going to see there's a huge opportunity. But that's what I want you to walk away with today, knowing where your opportunity is. For your clients that have good assets built out, you now have a fantastic single premium approach for them. For clients that have ongoing income, or maybe they're collecting RMDs or have a good pension or 401k annual distributions they're working with, you've got a great solution for an annual pay. Or if their money's in a qualified vehicle, 401k, IRA, 403b, you can lump sum out of that. Clients with annuities, walk away today just knowing where your opportunity is with your own distribution. Then you'll call Mark and say, Mark, I got a great opportunity. That guy was talking about, qualified money. I want to look at that. And then we'll go through them again in review. And the next 3 trainings we go through will really bring this home. Walk away knowing where your opportunity is. So let's start off by talking about the asset care products. Again, there's 4 products, but it's all the same, just funded differently. So this is whole life insurance linked to long-term care. So if it's whole life, of course, there's an investment vehicle associated with it, right? And currently, we have a guarantee interest rate of 4%, and that's where it's at right now. It's at the lowest possible rate of 4%. This is good news because the interest rate can only go up, and 4% really ain't bad. Now, that's, of course, a gross. That's not the net, but that's the gross interest rate. You can apply as an individual just by yourself, or you can apply with someone as well. And what's so interesting and extremely different about our products is that if you apply with someone, number one, it can be with any insurable interest that you have with them. In other words, it does not have to just be a spouse. This can be any family member. It could be a second cousin twice removed. It's an insurable interest. It could be a business partner. It could be someone that you're in a relationship with, living in the same household with. Same sex or not is irrelevant. That's a fantastic spread that you can apply with people. The only thing that has to be present is the age gap between the 2 people applying can't be greater than 25 years. The other thing that's very different about us is when you apply with 2 people, one premium will cover both lives because we work on a survivorship contract or joint life second to die, meaning in order for the death benefit to pay out, both insureds must pass away. That is huge because that allows us to use one premium to cover 2 lives, which creates bigger death benefits and bigger LTC monthly benefits that will cover your LTC expenses. That is a patented feature of ours and is a huge selling point to our product. We also work on joint equal age. So if you have a husband who's, say, 83, we stop at age 80. The husband can be 83, but the wife can be 70, and we come up with one age between them, and so he will be insurable. So what I just showed you, these bullet points right here, these hold true for all of the asset care products. So like I said, they all have a lot of similarities. So let's start by taking a look at Asset Care One. And Asset Care One is our product that works strictly on a single premium approach. So here's an example of a couple that has a joint age of 64 years old. And in this example, we're just going to use rounded numbers. They're going to put in a single premium of $125,000. That one premium is for both of them. For that, they're going to get a death benefit of $250,000. We're using rounded numbers, but this is pretty darn close to accurate to the actual numbers you're going to see. So here's your base. This is the base of the policy. A premium comes in of $125,000, creates a death benefit of $250,000. Now, if they need this for long-term care, they're going to get access their death benefit. They're going to use their $250,000 to pay out for long-term care. And when they buy the policy, they have 3 different benefit options of how it could pay out for long-term care. They'll choose a 25, a 33, or a 50-month payout option. In this example, they chose 50 months. And by using simple division, we'll just divide the $250 by the 50 months, and that gives us $5,000 per month per person to cover long-term care expenses. Now, this is the base of the policy. And the three things you always want to remember about the base of any of our plans is, number one, any premiums that are put into the base have returnability. It's 100% liquid. So these clients can get back their $125,000 at any time they want in the policy. Number two, it's where the death benefit lies. So the death benefit, of course, here is the $250,000. And the third feature with the base is that it's always the first pool of money that will be used for long-term care. It's always the death benefit. Now, this isn't bad, putting in $125,000. They're getting $250 for long-term care, $250 for death benefit, but it's certainly not the reason why they're buying this policy. If they thought their maximum exposure was going to be $250,000, they'd probably self-insure. They want more, and this is where we're very different than the rest of the field. They can get more long-term care coverage in the form of a rider. We call this rider the COB, or the continuation of benefit rider. So they have two options. They can get more long-term care expense coverage, and their first option is to get another amount equal to the death benefit, or in this example, another $250,000. Or, and this is what separates us dramatically from all the other carriers in the industry, a lifetime benefit, an unlimited pool of money they can never, ever outlive. Meaning, they're each going to get $5,000 a month, or if they both happen to go and claim at the same time, it'd be $10,000 per month until they spend down their $250,000. Then they'd come over here, and if they chose a lifetime benefit, they'd get that same $10,000 a month that can never, ever be outlived. Or they could buy the $250,000 option. The difference here, of course, is price. Well, they're buying the base by putting in a single premium of $125,000. How are they getting this rider? Well, this is where we have a lot of flexibility. They have a lot of different ways they can pay for this. Number one, the way about 80 to 90% of our applications come in, they'll pay an annual premium. Now, if you think about traditional LTC right now, first of all, you can't get a lifetime benefit nearly anywhere. But if you could, for a 64-year-old couple, at $5,000 per month per person, you'd probably be looking at $12,000, $15,000 a year. To get a lifetime benefit with us, you'd be looking at about $1,200 a year. That's for the both of them combined. So you put in a single premium of $125,000, and to get the lifetime benefit rider, it is ridiculously inexpensive. You could also get the other benefit over here, the $250,000, your choice. It's a little less expensive, but there's such a small price difference between the limited option and the lifetime benefit. Most people just tend to go with the lifetime benefit. Now, you have flexibility here. This could be an annual pay up to age 100. This could be a 10 pay, which of course would make it more expensive, but you're done in 10 payments. It could be a 20 pay, or your clients that really are very, very asset heavy, you could do a single pay as well. Just come up with $150, let's say $150,000. Put $125,000 in the base, and just put another $25,000 down on the rider and be done with it. What's so neat about our products, though, is generally the biggest issue people have with traditional long-term care insurance is that premiums go up. With our products, our premiums are non-cancelable. Where all traditional LTC is guaranteed renewable, ours are non-cancelable, guaranteed renewable, meaning our annual premiums, I'm not going to tell you our premiums have never gone up. I'm going to tell you they can't go up. And that is a huge, huge pressure release safety valve that most people are looking for when it comes to these kind of products. So this is the base, and this is the rider. Remember, the base is where your money's liquid. You can always get all this money back. Where your death benefit is, and it's always the first pool that will be used for long-term care will be the death benefit. The rider, these are annual premiums or a 10 pay, 20 pay, or a single pay. These premiums have no liquidity to them. You can never get them back, but man, getting a lifetime benefit that you can never outlive is critical. And where we're so different than everyone else is, once again, we have a lifetime benefit that nobody has. We have premiums that can never increase. We have a single premium covering 2 lives with any insurable interest, and those are extremely beneficial factors that you just won't see anywhere else. And this is available for people between the ages of 40 to 80. If you're applying together, we'll actually go as young as age 35. And remember, we can go over age 80 if you're applying with someone younger than you because we work on a joint equal age. Now, I want you to really grasp this concept of both base and rider because this is what you're going to see throughout all of our products. This is really how all of them work. It's a base rider approach. The question is, how are you going to fund it? So this is Asset Care 1, and this is just showing you the different options, a 50-month base payout, a 33-month base payout, or a 25-month base payout. And this is just showing you what it looks like on an illustration. And here's some cool did you knows, which we're really not going to get into too much right now. Okay, so I want to talk about our Asset Care 3 product. Again, very similar to Asset Care 1, looks exactly the same, right? Here's your base, here's your rider, here's your base with a death benefit of $250, 25, 33, or 50-month payout. Here we're showing you a 50-month payout. Then you have your rider. You can get, another amount equal to your death benefit, or you can get the lifetime benefit. Same exact thing as Asset Care 1. And we're skipping Asset Care 2, by the way, because Asset Care 2 and Asset Care 3 are the exact same product. The difference between this product and the one I just showed you a minute ago is instead of bringing over a single premium to create this death benefit, this is now going to be a 20-pay product. But we're also not going to be bringing over any old money, cash, non-qualified money 1035 out of the existing life policy. We're going to use qualified money, and that's what makes this product so unique. So let me show you how we do that. So I'm going to use an hourglass as a good illustration to show you how this works. And what I want you to imagine is the top half of this hourglass is an IRA sitting at One America. And in this IRA is an annuity that's earning 3% interest. And the bottom half of this hourglass is this whole life linked to long-term care policy, the policy I just showed you, but now it's a 20-pay. So let's make this real simple. Let's grab $125,000 out of some guy's 401k. It could be a 401k, it could be an IRA, it could be a 403b. And we're going to take that $125,000 and roll it into our IRA at One America. And in that IRA is just a vanilla fixed deferred 3% annuity. And what we're going to do is every year for 20 years, we're going to take a 6.5% withdrawal from the IRA. So year one, we'll take 6.5% withdrawal from the 125, that's $8,000, and we're going to use that to fund this 20-pay whole life linked to long-term care policy. So year one, that's going to create a death benefit of $133,000. That's also usable, of course, for long-term care. So we pulled out $8,000 from the IRA. It was worth $125,000. Now it's worth $117,000. So if you total up the value in the annuity in the IRA of $117,000 plus the death benefit of $133,000, which is usable for long-term care, $117,000 and $133,000 equals your total of $250,000 made available. Now, this $8,000 that comes out every year, yes, this is taxable. They will get a 1099 for that, but think how applicable that is to people that are older than 70 and a half, where they'll be able to use that $8,000 withdrawal to satisfy all of or a portion of their RMDs. That's a fantastic selling point, and people love that. So what we're doing, in essence, is instead of taking $125,000 straight out from their 401k and getting hit with a one-year huge tax penalty, we're spreading that out over 20 years, putting this in a nice cellophane-wrapped package product that's going to, you do the paperwork once, and it's done forever. And just every year for 20 years, they're going to get a 1099 that will satisfy RMDs. And over 20 years, the annuity will drain down to zero, and the life-linked LTC product will build up until it reaches this $250,000. And that number moves a little bit, but it's a tax-free death benefit usable for long-term care. And the rider, of course, stays the same. they can get another amount equal to the death benefit, or here another $250, or a lifetime benefit, and they can use 10 annual pay, 10 pay, 20 pay, or a lifetime or single pay to pay off the rider. So that's Asset Care 3. Asset Care 2 works the exact same way. You would use an annuity to fund the LTC linked life policy, but it works with non-qualified money. Not a lot of reasons to do that unless you're coming from like an existing annuity, but we would use our annuity products for that instead. Like I said, exactly the same as Asset Care 1, right? Here's your death benefit, which is used for long-term care. Then you have the rider, but instead of doing a single premium into it, we're going to take qualified money, put it into our IRA, drain it down for 20 years to build it out. Same exact thing. Then for clients who maybe are a little more income heavy, can do our Assets Care 4 product, but which again looks like the same exact thing, right? Here's your base. You put money in the base, it creates a death benefit. That death benefit can be used for long-term care. You can choose 25, 33, or 50 months as the payout option. Here we're just showing you the 25 months, and the rider always stays the same. If you choose a 25-month base payout, your rider options will be your death benefit, which is 25 months or lifetime. And of course, the rider, you always fund it with an annual premium, a 10 pay, 20 pay, or single pay. The difference with Asset Care 4 is just we're going to fund the base with annual premium payments. So this is our solution or our answer to traditional long-term care insurance. So for people who prefer to pay an annual premium, this is the solution for that. But the difference with us is, unlike traditional LTC, if you ever want your money back, you get a large portion of your money back. Or if you never use it, you have a death benefit. And your premiums, of course, will never, ever go up. Where with traditional LTC, not only have they, they're almost guaranteed to. And of course, we offer a lifetime benefit, which you can't get with traditional LTC either. So here's an example of a 55-year-old couple that's going to pay $2,040 a year. It's going to give them a death benefit of $100,000. And of course, that $100,000 will be used for long-term care. In this example, over a 25-month spend down, they'll each get $4,000 per month per person for long-term care, or $8,000 total if they go and claim at the same time. If they wanted the rider, they could choose their death benefit again of $100,000 or a lifetime benefit. I mean, this is really inexpensive. If they went with a lifetime benefit, it'd be $1,150 a year. This is showing you a very small policy, because that's what most traditional LTC policies are. They're pretty small. So in this example, your base is $2,040, your rider's $1,150. So for $3,200 a year, you're getting $4,000 a month per person forever, with a death benefit of $100,000. So I know there's still traditional LTC out there, of course. I find it very, very hard to try to find a reason why you would ever go with traditional LTC ever again, because you're looking at a product that offers no equity whatsoever, no death benefit whatsoever. You're certainly not getting a lifetime benefit, and your premiums, not only are they not guaranteed to stay the same, you can almost guarantee they ultimately will go up. The only difference with traditional is it might be 15 to 20% less expensive, possibly. And that's today. You have to realize what's going to be in 15, 20 years, and also realize you're still not getting a death benefit. You have no liquidity, no lifetime benefit, and of course, those premiums are not guaranteed. So like I said, it is all the same. You have a base, you have a rider. How do you want to fund your base? And this is, again, where I talked about just come away knowing your opportunity. For your clients that have money, and they really prefer to pay things in one lump sum, you now have a fantastic single premium approach. Dropping $100,000 gives them a death benefit, which is usable for long-term care. They can come over here. They can buy a rider with annual premium or a single premium, however way they want it. By the way, the rider, this premium over here on all of the products, can be paid with HSA dollars. Also, if your clients own a business, the business can pay the premium, and it is 100% deductible to the business. So if your clients own a plumbing shop, or they're a contractor, or whatever they own, the policy doesn't have to be in the business name. It can be in their individual names. They just have the business stroke the check on the rider, and it's 100% deductible to the company, which is fantastic. So again, whether they want to single pay this thing, whether they want to annual pay this, whether they want to take money from their 401k or IRA, you've got a solution. What I love about this, it is never a square peg in a round hole. Where your client's money is, whether they're single or joint, you're always going to find the right solution based on what their financial situation looks like. And on this product, Asset Cure 4, this is annual pay, but it can be very customizable as well. It can be a 10 pay up through a 20 pay. So you can do a 14 pay on the base, and the rider options are always the same, of course. Annual pay, 10 pay, 20 pay, single pay. That doesn't change. But with Asset Cure 4, where it's pay as you go, that's customizable. Why is that valuable? Because maybe your clients, they're budgeted $8,000 a year for long-term care. You can say, okay, for $8,000 a year, I can put you into a 14 pay on the base, give you a lifetime benefit, and boom, you're done. And then you're done in 14 years. And that kind of stuff is pretty exciting with the flexibility. This is available for people between the ages of 20 and 80. Again, don't worry about remembering this stuff. Remember your opportunity. I got great pay as you go. I got good 10 pay, 20 pay. I got good single pay. I got good qualified money options. So that's the Asset Cure products. Those are all the whole life linked to long-term care. Now I want to talk to you briefly about the annuity products. We've done it in about 10 minutes, so hang in there. You guys are doing great. Again, download the handouts that I gave you, a couple of them. One of them in particular is an Excel sheet that puts all the products in a grid with their issue ages, the chassis, the funding options. I'll show you that piece. It's great. And if you have any questions, of course, please type away your questions in the control panel. All right, you're going to absolutely love the annuity products. Whether you're selling annuities or not, it's irrelevant. What you need to know is a large portion of your clients have them, and they're not using them for income. Why are these annuity products such a huge opportunity? Well, first of all, the government did Gallup poll and found out that nearly 80% of all annuities are not being used for income. They're earmarked as emergency fund money. Basically, long-term care. People buy these, they put them in, they saw a good interest rate, they had money on the sideline, they socked it away, and they said, God forbid I ever need something in an emergency, when they're mostly thinking long-term care, I got this money there. But they're, by the way, one of the worst products of all financial solutions to die with gains, because it's taxable, and it's taxable to the estate, and it's taxable to the inheritance. So the government realized this and said, okay, what's happening right now is people have annuities. Here's a good example of a guy that bought an annuity for $50,000. Let's say it gained $100,000. Now it's worth $150,000, but $100,000 are gains. That's taxable. So when this guy uses this annuity for long-term care, the gains come out first. $100,000 comes out first. He pays tax on that, which gives him less actual money used for long-term care expenses. The government said, you know what? Looks like there's a good opportunity here to create more privatization of long-term care. The government does everything it can by creating favorable tax situations to privatize LTC because it is a huge draw on government programs. So they said, let's allow for the creation of annuities that will erase taxation if used for long-term care, if they're Pension Protection Act structured. And our annuities, of course, are. So what does that mean? A Pension Protection Act annuity. Well, let's look at the same annuity here that's worth $150,000 that has $100,000 gain. If this person took this annuity and rolled it into a Pension Protection Act annuity, this $150,000, including the $100,000 gain, is now 100% tax-free if used for long-term care. I don't know if you grasp what an unbelievable opportunity that is, because you have people sitting on annuities. 80% of them are not using them for income. It's being used for long-term care, and they're going to pay tax on all that. They can now take all the value in that annuity, make it tax-free, and get even more value than they're getting now. And that's exactly what we saw. And when the Pension Protection Act went live, in 2010, we went live with our annuity products to go with that. So we have 3 annuity products: Annuity Cure 1, Annuity Cure 2, and our indexed annuity. Let's talk briefly about the first 2 products, Annuity Cure 1 and 2. Actually, this is I have to update the presentation because we just raised our interest rates, which is fantastic. Our current interest rates for the LTC account value is now 2.85%. That's fantastic. So if you put in $100,000, that's going to go up 2.85% every year for the value that can be used for long-term care. The cash value is now, I believe, 1.5%. You can apply as an individual or as a couple, but if you are a couple, you have to be married. This doesn't work with insurable interest like the whole life product. And of course, one premium will cover 2 lives, and we do work on joint equal age, much like the whole life products. And all of our annuity products are Pension Protection Act eligible. So let's take a look at the first product, Annuity Care One. It's going to look very similar to what I showed you before. You put in single premium, and that premium will increase. The premium won't increase, but the base value will increase. If you put in and I'll show you an example in a second, but you put your money in, and its value will go up at 1.5% for cash value, 2.85% for long-term care value. And if you need it for long-term care, it'll pay it at 36 months. You can then get a rider, which will give you more long-term care, right? Our products all look the same. You have a base and a rider, and your rider options are another 36 months of care, or how about an annuity with a lifetime benefit? And we have that here as well. So how do you get the rider? Same thing, similar to the other products, not exactly the same. You can pay an annual premium or a one-time single premium. So let me show you how this works. Here's an example of an 81-year-old female that has a current annuity of $125,000. It's a non-qualified annuity. Doesn't need it for income, as most don't. It's got a nice guaranteed interest rate of 3%. Well, heck, our LTC interest rate is 2.85. We're not even far off from that. But a lot of this is taxable. This is all she has. It's only $125,000. So she says, you know something? I'm using this for a long-term care in my mind anyway. Let me roll this over into this great product and get a lifetime benefit. Well, she's 81. She doesn't want to really pay an annual premium. So she decides she just one and done this. So she takes her total value of $125,000 and puts $102,500 into the base, and puts the additional $22,500 into the rider. So if she needed this day one out of the gate, she's got $102,500 made available to her. And if it's divided over 36 months, so she's going to get about $3,000 per month, which is about $36,000 a year. But again, it's all 100% tax-free. Once she uses the base up, she'll come over here and she'll still get this $36,000 a year. She bought a lifetime benefit. So we took an annuity that she has right now, only worth $125,000. The majority of it is very taxable. Only a 3% interest rate, which is throwing off less than $4,000 a year. Turned that into $36,000 a year, tax-free, for the rest of her life for long-term care. And if she never needed it, she could always take her $102,500 back, minus surrender charges over the first 9 years. And if she dies and doesn't use it, it'll always pay out as a death benefit. Like I said, you're never really buying anything with the asset care products or the annuity care products. If you don't use it, it pays out a death benefit. If you want your money back, you can always get your money back on the products. This is called Annuity Care One. It's available for people up to the ages of 85. It is a fantastic product. This will work on an individual or for a couple if they are married. So this isn't bad. I mean, we loved this product. It was our first stab at it. She put the $125 in, got fantastic value out of it. But what we realized, because she could also annual pay this. She could have put $125 in the base and paid an annual premium on the rider. What we realized is most people that are coming into our annuity products will be coming from an existing annuity. And we said, why don't we come out with a product where they can put money in the base, we'll give them a rider, they don't have to pay an annual premium, they don't have to break off a piece of the annuity coming in right now, which looks not as good on the ledger sheet. So we did that. We came up with another product called Annuity Care 2, where you put in a premium into the base, and that's what it looks like here. Same interest rate, 1.5 for cash, 2.85 for long-term care. And if they need it for long-term care, as an individual, it pays out over 24 months. A couple, it pays out over 30 months. The difference with this, and this is one of my favorite products, is the rider is just included. They can get an additional 36, 72, or 108 months of long-term care included in the plan. How do we do that? if they're dumping in a premium here, we're not making them pay an annual premium. We're not making them pay a single premium. How do we just include one of these options? We do that because, remember, we're paying 1.5% cash value. We're going to take monthly charges off of the growth on their annuity to pay for one of these rider options. Of course, the longer the rider or the bigger the rider, the bigger the monthly charges. And what this really translates to is if they went with the 36-month option, they're going to get a total value of 2.5 times what their base has grown to for total long-term care value. So if their base grew to 200 and they chose a 36-month option, it'd be 2.5 times the base, the 200. The 72-month option is 4 times, and the 108 option is 5.5 times. And most of the time, you're probably going to go with the 72-month rider. It just neatly falls right in the middle. The monthly charges aren't that bad, and 4 times is just such a nice number. I mean, look at the values on this. This I'll show you on an illustration. This, by the way, goes up to the age of 80. That's what we'll write up to that age. Here's an example of a guy that puts in $150,000 single premium. A lot of it was taxable. So we now just took that and made all this non-taxable. And what we're showing you here is just year one numbers. So at the end of year one, his base went from 150 to 152 and change. So if he needs it for long-term care, that's his first pool of money. This is also what he can get back if he wants his money back. And if he dies, what we pay out on the death benefit. Now, if he uses it for long-term care, he'll use the 152 in full till it's gone. He chose a 72-month rider, which means he gets a total of 4 times the base, right? 4 times 152. Total LTC is almost $610 grand. The 457 is what he gets in the rider. So look at this. We took $150,000 sitting in an existing annuity that had major tax consequences, turned that into almost $610,000. All of it 100% tax-free. If he wanted his 150 back, he gets it in a death benefit, or he gets it over 9 years. There are surrender charges like any annuity, but he can always take his money back. And if he never uses it, he pays out as a death benefit. I mean, if you look at the illustration on this, it's fantastic. This is showing you year one numbers. Here's $150,000. This is his cash value. This is what if he ever wanted this for loans, or it's also the same what would pay out on death. So 10 years later, if he never used it, his 150 is worth 154. He actually made some money. The surrender value, it's really never that bad. 10 years down the road, if he says, hey, I don't want this annuity anymore, he still makes over $4,600 because he put in 150. The LTC value, remember, this is going up at a much higher rate, almost like like an income account on a regular annuity. 10 years later, his 150 is worth 174. He made 24 grand if usable for long-term care. This is his first pool of money for long-term care, the 174. He chose a 72-month rider. That's the continuation of benefit balance. So when the 174 is used up, 10 years down the road, this has now grown to 525,000 more LTC expenses made available to him for a total pool of almost 700 grand 10 years later. He gets a monthly benefit, which also grows to almost 7,300 a month. I mean, you don't get an easier sale. You took an annuity worth 150, not used for income, major tax consequences, and in 10 years, it's worth 700,000. No tax whatsoever for long-term care. Dies, never use it, you make money. Wants his money back, you get it back, and a nice $7,300 per month per person for long-term care. There's no easier sale. And then the indexed annuity, I'm going to go into very, very briefly because we're short on time. It works similarly to Annuity Care One, where you put a single premium into the base, and then you get a rider, and you have 3 rider options. A rider that would give you twice your base, 3 times your base value, or a lifetime benefit. And you get this rider, like Annuity Care One, by paying an annual premium or a single pay option. The difference with the indexed annuity is the base doesn't go up on a fixed interest rate. It will go up based on a crediting strategy against the performance of the S&P 500 index. I'm not going to go into that crediting strategy. Even if I did a whole training on indexed annuity alone, I wouldn't talk about that crediting strategy because it's irrelevant. Because our indexed annuity, like all of our products, are not about income. It's about long-term care value. And the only thing you want to know about the indexed annuity in terms of how the base will grow in its long-term care value is, number one, the guarantee zero, meaning our clients will never participate in any losses, the S&P 500 might realize, only in the gains. And the other thing that you only want to be concerned with is when they need this for long-term care, your base value will go up because there's a guaranteed LTC step-up bonus that they're going to get. And where the guarantee works great is the step-up bonus is there's two options. One option is on the actual performance of it, and the other is on what the original premium is. So regardless of how this performs, because there's such a huge bonus on the original premium, your base will always go up dramatically, which of course also affects the rider. The indexed annuity is a fantastic product, but I'm not going to go into it too much. What I do want to bring up to you is, I know I threw a lot at you. And again, I'll reiterate, the only thing I want you to be concerned with is remembering the opportunity. Don't worry about remembering the products. Just remember, for clients that have good assets, they're under 70 years old or even in their mid to late 70s, and they've got strong assets, you now have a fantastic single premium approach where one premium will cover 2 lives, and you can give them a lifetime benefit and know they're guaranteed protected. For clients with good annual stream of income, you've got a fantastic product for that now. For clients that have their money in a qualified vehicle, 401k, IRA, 403b, you've got a great answer for that will also simultaneously satisfy RMD requirements. For clients that have annuities, and whether you sold them to them or not, and whether you sell annuities or not, you need to know a lot of your clients have them, and they're not using them for income, and they are unbelievable funding sources that we can now mitigate all taxation on if used for long-term care. You've got a good option for that. And what I'm going to urge you to do is absolutely positively do not miss the next training, because what we're going to do, and this will be April 10th at 10 a.m., is I'm going to briefly spend 5 minutes and do a review of what I covered today. Just, say, remember, ASIC Year 1's our single premium, 4 is our annual premium, blah, blah, blah. And I'm going to go through 5 actual case studies of what the most common profiles and cases that you would see in the field, and show you based on that what product you'd want to go with, how to sell it, how to design it, and then explain it out on an illustration. And this really brings this home together. It's going to dramatically help you with adoption and understanding where this fits and how to position it. The other thing we're going to show you, and you really don't want to miss this, is an unbelievable tool that we have, which is our rate calculator, where you don't need to be an agent with us or contracted with us. You don't need even a username or password. It's 2 clicks and you're in, and it literally will take 30 seconds for you to run your own quotes. And of course, in the beginning, you might want to work with Mark to know that you're or whoever you work with at Issue Insurance. But this is an incredible tool to start getting comfortable with how our products work. And we'll show you how the rate calculator works. And then I'll also take you through to our e-ticket platform, our drop ticket, which is just a very, very simple 1, 2, 3 process on our new application submission. We have a drop ticket, a 2-page paper application, or even right from our rate calculator, you can submit an e-ticket whether you are contract with us now or not. So we're going to go through some good tools there, but you don't want to miss. Actually, excuse me, we're going to do the tools. Go through those tools a little. I'll show them to you briefly, but we're really going to do the case study on April 10th. You don't want to miss that. You'll get an email from Mark on how to register for that, probably within the next day or so. I'm going to urge you to do that. This call, by the way, was recorded, so if you want to come back and listen to this, you absolutely can at your leisure. Also, Mark will send you a link where every week, every week, our internal sales desk supervisor does a training very similar to this that you can join in and listen to at your leisure. Mark will send you the link to do that. So what I'm going to ask you to do now is, if you have any questions, I'm going to ask you to go ahead and type them out in the GoToWebinar questions box that you'll see there. Continue downloading the handouts, And while you're typing away your questions, I'm going to give you just a couple minutes to do that. I want to show you some of these pieces that I included in the handouts. The first piece, where it says all products final, is this PowerPoint that I just covered with you. The next piece is just a PDF brochure on our new drop ticket platform, which is fantastic. This other one is our product grid. We're going to go through that next week when we do the case study, but this is very helpful. It shows you, based on your client's age and where their money is, what the right product is to go with. But what I really love is this piece that I personally created. It's a quick reference guide, and this will work on all the products. Down here is a tab for the AssetCare products, or if you look down on my screen, that's where the tab is, the Annuity Care products. But here's the AssetCare. Look how easy I made this. The columns are AssetCare 1, 2, 3, and 4. The rows are, what's the policy structure? Well, AssetCare 1 is a single premium. AssetCare 4 is, flex pay how you want. AssetCare 3 is, it's a 20 pay, but comes from qualified money. How do you fund the base? Well, single premium or, 10 pay, 320 pay on the AssetCare 4. What are the issue ages? How does the base pay out? Well, they're all the same, 25, 33, or 50 months. That's base payout for long-term care. The continuation, the benefit options, that shows you that. What are the funding options on the continuation? That's always the same anyway. Spousability, well, with the AssetCare products, it's any insurable interest. 25-year age gap tells you that there. Will it take qualified money? None of these do, of course, except AssetCare 3. What's the minimum premium? And what's the underwriting? And we'll talk about that a little next week as well. And that shows you for the AssetCare. Down here on the Annuity Care products, it shows you this as well. What's the policy structure? How do you fund it? What are the issue ages? I mean, this thing is just really, really handy as you start writing with us. Yes, sir.
Keith, we're coming up on the end of the hour, and I promised it wouldn't last longer than that. You did a phenomenal job. Your enthusiasm, your passion, your knowledge, we really appreciate it. I want to thank everybody who attended today's webinar, and recommend that you reach out to your relationship managers, Angie Rice, Tana Heisey, or myself, Mark George. And we look forward to helping everybody to use this tool so that you can go help your clients.
Yep, we are at the end of the hour. I was actually just killing time to give people an opportunity to type some questions in and show what the handouts are and get those handouts. I'm not seeing any questions, so Mark, I'm going to say you got a smart bunch here. They understood everything. If you didn't have time to grab the handouts, we'll send them out with the follow-up. But again, thank you for joining. I'll echo Mark's comments, and we look forward to seeing you on the next few calls over the next month or so.
Thank you, Keith.
My pleasure. Thanks for having me on, Mark.